Welcome to the Allan Small Financial Show. Thank you once again for taking the time out of your busy day to spend it with us. Over the last year and a half or so, we've had the pleasure of having some fantastic guests. And today is absolutely no different. We've had some great political guests, politicians. We've had some experts in their field. Today, we have a gold expert coming to you on our show. David Garofalo, Chairman and CEO of Gold Royalty Corp, will be with us shortly to talk everything gold. And then we're going to hopefully be able to get into some of the questions that individual investors have for us. We're going to talk about some of the questions that investors have on their minds today. Market is at or near all-time highs. What are investors thinking? So we're going to try to answer some of those questions. And as you can see on the monitor here, we have a number of topics for you again today. Like as I said, a lot of these topics come from conversations I have with individual investors throughout the, 2 weeks from show to show. And here's what we have for you for this show. Gold on the Rise, an interview with David Garofalo, Chairman and CEO of Gold Royalty Corp. We'll speak to David in just a moment. Top 3 things to consider over the next 10 business days before you make your investment decisions. As always, we always bring you 3 ideas. And I think 3 ideas for you to focus on today are pretty good ones. TSX significantly underperforming the U.S. S&P 500. Why is the Toronto Stock Exchange, the TSX, not doing as well as the U.S. indices, especially the S&P 500? And this has been going on now for quite some time, not just 1 year, but a number of years. We'll talk and we'll delve into that. What will rate cuts mean for the stock markets? A lot of people are waiting for that first rate cut. A lot of investors are waiting for the first rate cut. What do you think the stock market's going to do when that rate cut happens? We're going to discuss this, and you may be surprised to hear what I have to say that the market's going to do when we get that first rate cut. Bitcoin has been surging. I think if you've been looking at the news, or if you're an investor that likes the speculative side of things, you've been noticing that Bitcoin has surged to all-time highs over the past week once again. We're going to talk about Bitcoin, what has made or caused Bitcoin to get back to its all-time high, and is this a good investment for the average investor? And lastly, your questions. As always, if you have a question during the show, please put it in the chat box. We love to be able to answer it during the show. If we don't get to it during the show, I'd be happy to answer it after the show or during the few weeks leading up to our next show, or possibly even answer it on our next show. So without further ado, let's move on with the show. So I'd like to welcome David Garofalo, Chairman and CEO of Royalty Corp. David was named Mining Person of the Year in 2012 by the Northern Miner. He was also Canada's CFO of the Year by Financial Executives International Canada in 2009, Top Gun CFO by Brendan Wood International, and he was recognized by IR Magazine for Best Investor Relations by a CEO in 2011. David is kind enough to once again join us from Vancouver. David spoke to us. I don't know if you remember, David. It was back in February 2023. And once again, I'd like to welcome to the show David Garofalo. Welcome, David. Oh, there he is.
Hi, Allan. Thanks so much for having me on again.
My pleasure. My pleasure. And as always, a great hot topic. Again, where a great guest yourself coming to us to talk to us about the latest hot topic, whether it's Bitcoin or whether it's gold, both things surging tremendously in the markets over the past bunch of weeks anyways, maybe even the last few months. And I thought we'd start off by, asking just a basic question. And you and I were talking off air before the show about this already. And I thought for the viewers, I'd start off by asking you, why would anyone be buying gold today or at any time? Is it truly a hedge against the US dollar? We hear all the time that gold is a hedge against the US dollar. If the US dollar were to falter, that's when gold does the best. If there's chaos in the world, gold does the best. But I always bring the point up, is it really a hedge against the US dollar? If the US dollar were to falter, I think everything would falter with it, right? The US economy, largest economy in the world. 20% of the world's wealth flows through its borders. If the US economy and the dollar were to go down, would it matter that you're sitting on a whole bunch of gold? And what investor actually has enough gold in their possession to balance or hedge against a faltering US dollar? So I ask you the question, why would anyone be buying gold today or at any time?
Well, it's not only a hedge against a faltering US dollar, but against fiat currency generally. So if you look at all the currencies in the Western world, we've seen a significant devaluation of those currencies really since the great financial crisis, if not before. There's been a massive expansion of money supply, and gold is an accurate barometer of what that does to inflation. As you expand money supply, the cost of hard goods go up, and we've seen that. We've been in the midst of an inflation cycle unlike anything we've seen since the 1970s. So if you look at gold as a hedge against the devaluation of paper currencies, it's done exceedingly well in the long term and in the short term. If you look at when gold was decoupled from the US dollar back in the early 1970s, the US government abandoned the gold standard. Gold at that time was $35 an ounce. Today, it's about $2,200 an ounce. The purchasing power of a US dollar has gone down over 90% since that time. So gold has been a very effective hedge. It's the one true currency that can't be printed, can't be expanded in supply willy-nilly like fiat currencies. The only limit to paper currency is what the printing press can spit out. And that's what we've seen really occur over the long term. Most recently, we saw a pickup in inflation as a result of the excesses introduced into the financial system since the great financial crisis and even before that, as a result of expanding money supply. COVID was kind of the match that lit the dry forest, if you will, that kind of resulted in inflation finally rearing its ugly head. It's something we've been calling for a number of years, and finally we saw the evidence of that most recently as a result of the COVID crisis.
It's and valid points, obviously, with respect to gold and why and who should be buying it and why they're buying it. The economy has changed a lot since you and I got together last. I have some interesting statistics here. Inflation, when we spoke, I believe it was February 8th, 2023, inflation was 6.3%. Today it's 2.9. Unemployment was around 5%. Today it's 5.7%. Gold was roughly 1,860 an ounce. Today, as you said, getting close to 2,200. Predictions of an approaching recession were out there, but yet we really never fell into a recession. How has the gold market adjusted to these conditions over the past year? And what's been spurring on the gold price primarily over the past year? Something to making it different than where it was sitting a year ago.
Well, the unfortunate truth is that headline inflation numbers actually vastly understate the reality on the ground. None of us are experiencing 2 to 3% inflation or even 4% inflation. If you're putting food in your stomach, fuel in your car, a roof over your head, you're deeply into double-digit territory. Mortgage payments have gone up 70 to 80%, monthly mortgage payments as a result of the increase in interest rates. So we are all experiencing a significant devaluation of the purchasing power of our currency. And the headline numbers unfortunately understate that. They lull us into a false sense of complacency. Gold is an accurate barometer of what inflation really is. And interest rates are not positive. They are on a nominal basis. They have gone up on a nominal basis quite dramatically. But on a real basis, when you consider real inflation on the ground, which I believe is double digit, and many prognosticators in the market believe we're likely in an entrenched inflation cycle for quite a period of time, we're actually into negative real interest rate territory. So if you own a treasury bill, whether it's in Canada or the US, you're actually seeing your purchasing power, even with nominal interest rates approaching 4 or 5%, actually going down. So it's eating away at your purchasing power, even as you think you're enjoying a higher interest rate, because real interest rates are dramatically negative and likely to accelerate deeper and deeper into negative territory. That means the opportunity cost of owning gold, which is really a financial instrument. It's a currency. It's not a commodity in the strictest sense of the word. That the value of that is going up because the opportunity cost of owning it isn't there. And currencies trade relative to each other based on relative interest rates. So gold, yes, is yields zero, but treasury bills are yielding negative on a real basis, and that's what really is driving capital into gold.
You make a good point. Gold not being a commodity, it's a currency because really, what do you use gold for other than wearing it around your neck or on your wrist? It's not, doesn't really have any use, industrial or manufacturing. So yeah, I think gold should be looked at as a currency. JP Morgan recently talked about gold reaching $2,300 an ounce by 2025. What do you think about that prediction? And do you think this prediction has anything to do with the fact that they believe central banks or let's say the Fed in particular will be cutting rates the second half of this year?
Yeah, I think that is a function of that exactly. So it goes back to the point I just made about interest rates going down deeper into negative territory. And the central banks are pivoting, in my view, prematurely because I think inflation is much worse than headline numbers tell us. And so if they pivot early, what will happen is you'll start to see a flow of capital out of, accelerating flow of capital out of treasury bills into gold and commodities and hard assets generally in order to protect against inflation. So hard assets are finite in quantity, paper is infinite in quantity. Again, the only limit is the printing presses. So I think that's really what's going to be driving capital into gold and other commodities in the foreseeable future. And the reason the Fed has to pivot is not because inflation is slain. It's because debt levels are at exorbitant levels relative to where they were in the last big inflation cycle in the 1970s. Global debt to GDP today is a remarkable 350%. Global debt to GDP in the 1970s was only 100%. So there was a lot more latitude at central banks in order to increase interest rates to tame inflation. And we saw interest rates go to 20% and above back in the early 80s in order to tame inflation numbers that were 14, 15%. Central banks do not have the appetite to do that because the debt levels are unserviceable at that level. For example, in the US, debt service has doubled in the last 18 months to $1 trillion per year. US federal government debt service. That's one out of every $7 of taxes generated in the US. If interest rates stay at these levels for another couple of years, as these treasury bill rates reset, it could double again. It's unsustainable. So effectively, the central banks have to inflate their way out of debt. They have to grow the economy through inflation so that debt to GDP goes down as a result of that inflation. That's the only fiscally responsible way for them to repay the debt, unfortunately.
Yeah, it, I guess puts even more emphasis on the election coming up at the end of the year. The new administration, what they're going to do, and a lot of people are talking about that. 34 trillion in debt, I believe, is the number, and so it's definitely a problem, especially with higher interest rates. Over the past, well, many years, but especially in the last year, the Chinese central bank, they've been purchasing a lot of gold, and we hear obviously central banks buying a lot of gold from various countries. Do you think they're gonna, they can keep up the buying? And I guess a second part of that question would be, other than central banks, who else is doing the buying right now? Is it primarily central banks, or are there other bodies that are looking at buying more and more gold going forward?
No, your comment on the Chinese central bank is quite apt. They are the biggest consumer of gold. And I'm not just talking about the central bank, but China generally, because it's a deregulated market. Individuals can own gold, and they have an underlying mistrust of their fiat currency as well. So we're seeing consumers in China, central banks in China, consuming gold at unprecedented levels. And they have become the biggest importer of gold in the world, eclipsing India, which traditionally has been, because of the wedding culture there and the value of gold to the wedding culture being a big source of demand longer term. China has eclipsed that. And China is not only the biggest consumer of gold, it's the biggest producer of gold in the world as a country. And so they're consuming everything they produce and also importing more than any other country in the world. And the reason they're doing it is because China is an export-oriented economy. It's the biggest export-oriented economy in the world. So they're dealing with an avalanche of foreign currency proceeds, particularly the US dollar. And they see the writing on the wall in terms of the devaluation of that currency. And they're diversifying their central bank reserves as rapidly as possible. And now that individuals can buy physical gold readily on the various exchanges within China, they're diversifying out of their fiat currency as well in order to protect the purchasing power of their savings.
So I guess to sum it up for investors that are watching our show, because it's obviously an investment show, and that's investors are watching right now. If someone were to want to add gold to their portfolios, what would you say, or what would you recommend? Would you own gold certificates, so gold itself, or would you be buying gold stocks? The miners themselves, obviously, there are risks or pros and cons to both. But what would you say as an investor? Where would you be investing your dollars?
Well, the lowest risk way to do it is to just buy physical gold. You can buy it at a bank, or you can buy the ETFs that are physically backed by gold that are major exchanges like the NYSE. But if you want leverage to the gold price, you want to look at equities because they provide leverage in terms of profitability as the gold price goes up that exceeds the percentage increase in the gold price. That's the beauty of having that kind of margin. Unfortunately, the producers have underperformed the commodity for a number of years. And there's been a huge divergence between share price performance of the equities, the operators in particular, and the gold price because of the overhang of cost inflation. So the inflation we're all experiencing in the general economy, the miners are not immune from that. So if you're running a mine, you're dealing with labor inflation, energy inflation, input cost inflation generally. So that's weighed on their margins and weighed on the leverage to the gold price. So after 33 years of building and operating mines, I decided when I came back into the gold sector after having merged Goldcorp with Newmont back in 2019, that I didn't want to run an operating company. I wanted to run a royalty company that had top line exposure at the mine site, which completely insulates you from input and capital cost inflation at the mine site. So we get a percentage of the gross revenue, and we get leverage to the exploration success of the operators that run the mines. As they drill out their deposits, we don't contribute to those exploration budgets, but we get the benefit in our royalty portfolio as those reserves grow. To me, that's the optimum place to get the best leverage of the gold price and leverage the exploration without actually having to pay for it.
David Garofalo, Chairman and CEO of Gold Royalty Corp. I want to thank you once again for coming on our show and talking to us about gold and shedding some light as to why gold has really taken off and where you see things going over the next couple of years. There's no doubt price of gold continues to rise, and many are calling for the price of gold to be a lot higher in the not so distant future. So thank you again, David, for being on the show.
Thanks, Allan.
All right, all the best. Take care. Now we come to the part of the show where I discuss what I believe is important for individual investors to consider before they make their investment decisions. Three things to consider, as we always discuss. First one, as you can see on the screen here, economic data and Fed speak. We're actually hearing the Fed, Jerome Powell, head of the Federal Reserve, speak right now. He's providing testimony on Capitol Hill, talking a bit about what he sees with respect to inflation and interest rates, and he'll be speaking on Capitol Hill tomorrow as well. Quarterly earnings takeaways. We just pretty much finished quarterly earnings season. There are a couple of big cap tech names I think are quite important that are going to report shortly in the next day or so. Broadcom, Oracle. But for the most part, we've seen a pretty strong corporate earnings season for the last quarter of last year. And here we are, beginning of March. So we only have a few more weeks left, and we'll soon be talking about the first quarter of this year. So we'll touch on some earnings takeaways and looking at investment ideas in different ways. We talk a lot on the show about being a contrarian investor. Well, not so simple just to buy those investments that are cheap and buy when others are fearful. You have to take a look at those investments closely, look at them from different angles. And we'll speak about some of the different angles and how to look at some of these investments. It's why it's not so easy just to buy the cheapest name that you can find out there. So let's move into the economic data and Fed speak. The first point that I want individual investors to consider before they make their investment decisions, and economic data that I want them to focus on. As I said, Jerome Powell on Capitol Hill right now, testifying in front of Congress, talking about what he sees regarding when interest rates could be lowered, talking about inflation and answering all the questions that politicians have. But soon after, we're going to get a jobs report out of the US and Canada. We'll get that this Friday, jobs report. We know that the jobs data out of the US was actually very strong last month. We have a chart that will show you that. Grew 353,000 jobs for the month of January. So it's a big number. There it is. A big number coming out. We saw December actually report almost as strong a number. So the February number will be key. I know the Fed really looks at jobs, and in my opinion, I don't think they will consider cutting rates until they see a little bit of softness in the jobs data. Next week, we're going to get CPI, inflation data out of the US. And again, obviously a huge number for the Fed to consider before they decide whether they want to cut interest rates or not. Before we get to that, actually, we have an interesting chart I wanted to show all of you and that love the tech space, and we talk tech all the time. It is talking about technology jobs. So before we move away from the jobs front, we can show you this chart, which is quite interesting. Newly listed US jobs in the AI space, IT jobs. And we were talking off air before this, how times have changed, right? For those that are looking for jobs in today's world or the world of the future, you're going to have to start looking at a lot of AI jobs, artificial intelligence versus IT jobs. Both of them, obviously, still good areas to be in, but artificial intelligence really starting to rule the day. And again, keeping with the unemployment rate, again, I think we actually have one more chart, which I find quite interesting. And this is a chart which shows us Canada broken down by province, where you see the highest unemployment rate. And my main takeaway from that is you tend to see higher unemployment rates in the Maritimes. You can see they have the highest rates. Lowest rates are in the prairies, Manitoba, Saskatchewan, and our province here in Ontario, about 6.2% unemployment rate, and actually moving higher. On average, you tend to see about a 7% unemployment rate in Ontario. We're slightly below that now, but if you look at where the unemployment rate has come from, we're starting to tick higher as we move along. And the unemployment rate in Canada has gone from a 5% unemployment rate, as I mentioned in my interview with David, to 5.7%. So unemployment is starting to rise, and that is perhaps helping bring down that inflation rate here in our country. So getting back to inflation, we're going to get a CPI number out of the US. We focus on the US often because a lot of the economic data out of the US matters more for the stock market than the Canadian data that we get usually right after it matters for the stock market. And that includes the Toronto Stock Exchange. The S&P 500 will move with inflation data, jobs data, whereas the TSX doesn't tend to move with the Canadian data. It actually moves also with the US data. So inflation numbers will be important, and we'll get a week after that. So in the next 3 weeks, we will get a meeting. Jerome Powell, the Fed, will meet to discuss the recent or the latest interest rate policy from the Fed, and that will come about a week after CPI. So in the next 3 weeks, you're going to get jobs, you're going to get inflation, and you're going to get an interest rate decision from the Fed. We actually received an interest rate decision from the Bank of Canada earlier today, 9:45 this morning. They held interest rates as is. They indicated again that they're pausing. We don't anticipate an interest rate increase, but we do anticipate a decrease in rates at some point down the road. Inflation in Canada, 2.9%, the headline number. As you can see on our next chart, inflation in the US actually coming in at 3.1%. That's their headline number. And core, which strips out volatile food and energy, that is still at 3.9%. So the hope is that we could see US inflation at their next reading under 3%. Hopefully we can see core in that 3.5% range. And I think those are important numbers along with jobs and a lot of the other economic data and announcements out of the Fed. Those are very important to consider before you make your investment decisions. Second point I wanted to highlight are quarterly earnings takeaways. And we had obviously a pretty positive quarterly earnings season. Most companies beat expectations, the expectations from analysts. And usually we tend to see a beat on the expectation somewhere in the vicinity of 70 to 80% of the companies beat expectations. So they basically do better than what was anticipated of them. But in my opinion, the main takeaway, and as I wrote on the as for one of the points was quarterly earnings takeaways. The takeaway for me this quarter or this past quarter's earnings season was that even though things are going well, they are slowing. There's no doubt about that. So even companies that said things are going well, they also said, however, things are slowing down as we look forward into the future. We're also seeing companies report beats on their top and bottom line, so better revenues, better earnings per share growth, but not as good as they were a few years ago. So definitely seeing a slowdown in corporate earnings and in some cases revenue as well. Perhaps the only exception is the tech space and the artificial intelligence area of tech. Those companies just seem to be knocking it out of the ballpark on a quarterly basis. So first chart I have for you actually, which is a pretty good example, is a chart of Target, a US retailer. Target came to Canada for a short period and then left recently. So they are a US retailer now, and they provide, toys and clothing, you name it, electronics, pretty wide range of goods. As you can see here, the day that they reported earnings were fantastic. Stock went up almost 13%. Has actually gone up a little more since then as well. But Target was interesting. Even though their earnings for the previous quarter were so strong, they said going out over the next year, they anticipate some softness. And it may not be until towards the end of the year that they would see some strength or increased strength once again. So again, another company saying things are good, but things are slowing down. Our next chart here we have of the Canadian banks. It's an ETF, the Hamilton Enhanced Canadian Bank ETF. And you can see here on the far right, bank stocks are moving higher again. Corporate earnings season, Canadian banks just reported in the last few weeks. And with the exception of Bank of Montreal, pretty much all the earnings were a success, beating on the top and bottom line. And interesting enough, when you look at whether it's Royal Bank or TD Bank or CIBC, their earnings that they reported this quarter were good, beat the expectation, but were not as good as what we've seen in the past. So once again, beating perhaps with respect to the banks, maybe a bit of a low bar that was set for the banks. So they came out on top, beat the expectations. But once again, keeping with our theme of things slowing down, bank stocks not making as much as they did a few years ago. S&P 500 chart that we have for you now, which shows that, yes, the S&P earnings per share has been going up since we reached the bottom in 2020. 2021 was a peak. We came down in 23, came down in 2022, and we went a bit higher in 2023 again, but we have never gotten back to our peak in 2021. So once again, things are good, but still not as good as they were. And we've seen a slowdown with respect to earnings. And in my opinion, that is the fear. The fear is that earnings from these corporations will not get back to 2021 until perhaps central banks start to cut rates. The fear is that things will continue to slow, and a lot of people worry that central banks might be too slow in cutting rates to stimulate. And if that were the case, or if that is the case, then perhaps we move into some sort of mild recession. So always the fear from investors that the central banks will react too slowly based on this earnings slowdown, based on this idea that looking forward, yes, things are slowing, inflation is slowing, but earnings are slowing as well. The third and final topic I want individual investors to focus on before they make their investment decisions, and I have a number of charts to illustrate this point, is looking at investment in different ways. And as I said off the top of the show, I always talk about being a contrarian investor. I think that's the best way to make money and to grow your wealth. Be greedy when those are fearful, fearful when those are greedy. A famous Warren Buffett saying, you want to buy low to sell high, buy weakness, sell into strength. But if you have kept with that idea, our first chart shows that probably wouldn't fly if you're looking at a name like NVIDIA. NVIDIA is a name that has had tremendous success. I remember when this stock was $100 a share, now well over $800 a share, reaching new highs this morning, I believe somewhere in the 885 range. And this is a name that you would say, as a contrarian, well, it's gone up, so we probably want to sell it and take our profits to buy something that is perhaps hasn't gone up as yet. However, if you look at this from a GARP approach, growth at a reasonable price, you're going to notice that NVIDIA today, trading at about a 35 times forward earning multiple, is actually cheaper today than it was a year or two ago when it was trading at well over 40, 50 times earnings. So if you are somewhat of a value investor, a GARP investor, growth at a reasonable price type of investor, you're going to say, I want to buy NVIDIA today because it's actually cheaper today than when it had its run or when it's had its run over the past year and a half. It just seems to be getting cheaper. The price isn't keeping up with how fast the earnings are growing. And that's why you want to look at these names. You just can't look at buying cheap stocks because, as we know, sometimes stocks are cheap for a reason. And we call those value traps. And sometimes stocks that appear expensive, they're actually not that expensive. We look at a name like Meta, for example, which is our next chart. Meta trades, I have it here, 25 times forward earnings, not that expensive at all. When you compare it to an AMD, compare it to an Intel, other chip makers, other big cap technology companies, these stocks are trading at well above 25 times. So even other chip makers are more expensive than NVIDIA, trading at 35 times. Meta or even a Google trading under 20 times. Big cap tech names that have had tremendous success. And if you were perhaps a contrarian, you might have sold these names to buy some of the cheaper names. I have some examples of some really cheap names that I say are cheap for a reason, that they can't seem to get out of their own way. They can't seem to grow the top and bottom line sufficiently enough to see their stock prices fall. And I point out a couple of auto companies. GM is our first one. GM trades at 4.5 times earnings. 4.5. You compare that to some of the tech names I just mentioned to you in the 20s, and you'd say, sell NVIDIA, sell Meta, buy GM. Well, even though this chart shows you that GM has had a bit of a run recently, if you look back long enough, you can see it really hasn't gone anywhere in the last few years. Ford, another chart we have, would be a very similar type of investment. Again, Ford actually hasn't regained its previous highs that it had a few years back. So if you were a long-term owner of GM or Ford, you probably would be somewhat frustrated that these stocks have not moved nearly as much as some of these high-flying tech stocks. Moving to some of the airlines, Delta Airlines, another name that trading extremely cheap, 6.5 times forward earnings right now. But again, what money would you have made in Delta Airlines? Air Canada, another airline, a chart that is, to me, shows us why those that have owned Air Canada trading at 5 times earnings, why Air Canada stock hasn't moved much. These names are cheap, but in my opinion, cheap for a reason. And the last chart I wanted to show you is a name that I've talked about many times on this show, and that's Bank of Nova Scotia. Bank of Nova Scotia trades at 10 times earnings, so not too cheap, not too expensive from a historical standpoint. Pays you a 6.5% dividend today if you were to buy it. And as you can see here, has shown pretty good growth since the lows at the end of October, beginning of November of last year. And I think a name like Scotiabank, which just reported great earnings, great international growth, great domestic growth here in Canada, I think a name like Scotiabank could be a good idea for those not only looking for growth, but also income, but also looking for a name to own for the long term and maybe even for the short term, as I just think that we are coming off a low in some of these banks like Scotia, and things will just continue to get better. So looking at stocks or looking at investment ideas in different ways, to me, makes a lot of sense for individual investors. And before you make your investment decisions, I think you have to look at not only just the lowest names or the stocks that haven't gone up as yet, but you have to evaluate them from an earnings per share, from a revenue, from a cash flow basis. I think these ways are looking at all the different angles are very important before you make your investment decisions. So TSX has definitely underperformed the S&P 500. And I think we can sum it up really quickly in two ways. I know there was a BMO economist recently that spoke a bit about this, but what it comes down to, in my opinion, is number one, the makeup of the Toronto Stock Exchange versus the S&P 500, and the two economies, economy in the US versus the economy in Canada. So just discussing the economies very quickly. Economy in the US growing 3-4% GDP right now. Economy in Canada, 1% at best right now. My opinion, I think the US economy being so strong has kept the Canadian economy from falling into what was once predicted a mild recession, because we export and what we pull out of the ground, 70% of that we send to the US. If US is doing well, then that helps our economy do better. But even still, we're still not growing at 3-4% as they have been growing down in the US. So I think that factors in when you look at the TSX versus the S&P. But probably even more important is what is the makeup of the TSX versus the S&P 500. TSX made up commodities, oil, banking, and by far the number one sector in the US is technology, whether it's communications, whether it's technology, many software, artificial intelligence. I basically put that all together and call that tech. And we know that the S&P 500 is made up of just under 50% technology today, just over 40%. And so technology has been the place to be. We've talked about this on the show many times. So unfortunately for the Toronto Stock Exchange, which is looking for the next, I guess, super cycle with respect to commodities, we saw one a few years back when China was importing everything you can imagine, from copper, all the different base metals. That really helped our economy here in Canada. And in my opinion, it's going to take China to come back strong. We know they're struggling right now, but to come back strong to help us here in Canada and help our markets, because we are a commodity-based market, right? We are also considered a petro currency for so long with our exposure, obviously, to the energy sector. So commodities, energy, not doing as well. Technology really knocking the lights out over the past, well, let's call it many years now. First chart I have here shows the equity performance of the different markets, indices. You have the NASDAQ, the one-year number here, 42% growth. You have the Dow Jones, 18%, S&P 500, 29%. A lot of people forget about the Japanese Nikkei, 45% over the last year. Unbelievable. Number one. Not many people know that Japan is doing that well. Compare that to the S&P TSX, you're looking at 6% growth. So obviously a huge underperformance. And in our second chart here, you'll see why. And it all has to do with what the makeup of the S&P 500 and the TSX is. You'll see on the TSX, 58.3% one-year return in technology, which is great. But how much of our market is tech? We have Shopify, we have maybe open text, and then you're pretty much hard pressed to find other big tech names that really matter on the index. Whereas you go to technology in the US, 59% growth. You look at communication services, 57% growth, and you really see there that it is the tech that is ruling the day. Consumer discretionary, 34%. So you have a lot of different names down in the US on the S&P 500 that are causing the S&P to really outperform the TSX. And unfortunately, I don't envision that changing in the near term. I think that the banking sector will continue to do better, as we showed you with the bank ETF in the previous segment, Nova Scotia Bank stock. But I think the banking sector, which makes up pretty large component, 25 to 30%-ish of our market here on Toronto Stock Exchange. So I think that will help. But I think if we're looking for help on the oil side or the commodity side, that might take a bit. Whereas if you go down south there's a lot of tech there. And again, a nice, I guess, reason why individual investors that are in Canada should consider investing abroad, consider investing in the US. Their market is larger. And as I've shown you, they seem to be, their markets seem to have the hot areas make up their indices a lot more than we have here on the TSX. So we're all waiting for interest rates to be cut, to be lowered by central banks, the Fed in the US, Bank of Canada. And we're all starting to grow a little impatient. A lot of people trying to hold on to renew that mortgage, waiting to see if they could get a lower rate. Perhaps the Bank of Canada will cut rates mid-year or later this year. But I think it's quite interesting to look back and to see what happens when central banks cut rates. And in my opinion, what I think will happen when we do get a rate cut coming up perhaps as early as mid-year. Our first chart here shows what happens to the US market when the Federal Reserve pivots and starts to cut. And to me, this chart really just shows me that there really is no steadfast or hard pattern here. We see, I guess, back in the 2000s when rates fell, the federal funds rate, which is in red, when that fell, so did the S&P 500 in the early 2000s, 01, 02, 03. They cut rates, but the market fell with it. And then as rates went higher in and around 2005, so did the market. Again, we had that financial crisis in 08, beginning of 09, they cut rates. And then really from 2010, the market was off to the races, even with higher rates. Rates went down. We had obviously the pandemic in 2020, rates came down. And now we've seen rates come back with a vengeance, right? We've seen rates going higher 10, 11 times. Market sputtered at first. And now market has reached all-time highs once again in the US. So is there a pattern there? Tough to say. But in my opinion, I think when they do cut rates this year, what I'm actually looking forward to is to actually see maybe initially the markets react positively to that rate cut. But then soon after, unless it is predicted that the Fed will cut rates many times going forward, you could see a sell the news phenomenon. Basically, buy the rumor that the fact that they're going to cut at some point, so you're buying into the market today, to sell when they actually do cut. Because maybe when they start cutting, maybe once or twice, that's as good as it gets. Or maybe the Fed isn't telling us something. Maybe they see some weakness that in the data that hasn't been released as yet, and they're cutting because they're seeing perhaps the economy is weaker than we all believe it is. So I think we could see perhaps the markets sell off on the news that they've cut rates, maybe not the first rate cut, but maybe on the second one. And to me, that would just be par for the course, right? We see it all the time with stocks. We buy into a stock thinking that the earnings are going to be really, really good. And what do investors do? They sell when those earnings reports come out, even if they're fantastic, because the average investor says, well, is this as good as it gets? And so they sell into strength. So maybe we actually sell our investments, or the average investor sells into the news of rate cuts. So be mindful of that. I think today we're in a sweet spot. I think the Fed has our backs. If the economy should falter, they're there to cut rates. If the economy should continue along its current path, the economy is strong right now. I don't think there's a need for the Fed to cut rates, and the market will just reflect a strong economy. So today, more so than maybe even when they actually cut rates, I think investors are in a sweet spot, and I like to call it a win-win situation. Bitcoin, as many of you know watching today, Bitcoin has surged to all-time highs once again, 69,000 US dollars per Bitcoin. Unbelievable. It wasn't long ago where Bitcoin was 20,000 and even below that. A lot of individual investors that got into the cryptocurrency market early on, if they weren't sellers, unfortunately, they rode the Bitcoin wave all the way down. Hopefully they continue to hold on because now they're higher once again. And has anything changed? Has anything changed to make Bitcoin or cryptocurrency in general more appealing to individual investors? Well, we obviously have a chart that will show you what has changed. And we can take a look at that here. I would point out that, yeah, BlackRock filed Bitcoin ETF back a little while ago, but really cryptocurrency, or in this case, Bitcoin, did not take off until the SEC, the governing body in the US, approved spot Bitcoin ETFs, making it available to individual investors, making it easier for individual investors to buy these ETFs. And I believe there's something like 10 of them in the US, 10 large ones, BlackRock being the largest, taking in billions of dollars into their ETF. Fidelity has one as well, taking in billions of dollars into their ETF. But I'm here to tell you that nothing's really changed with Bitcoin. It's still not backed by a government. It's not really backed by anything other than itself. You have other cryptocurrencies, digital currencies. Ethereum is waiting for their ETF to come online shortly, and you'll probably see their values rise recently. I think Bitcoin, for the most part, for investors is still a no-touch. Most investors just can't understand what the Bitcoin represents. You know, is it an alternative currency? Is it a way to do business? Is it a hedge against something? You know, the technology behind cryptocurrency, digital currency, blockchain, is that what is the most important? That what's most important? So a lot of people just don't get it, don't understand it. And it's definitely not for the faint of heart. It is something that moves substantially. It is something that will continue to move substantially. But as I said many times on this show, I don't think it's going away. And we hear more and more about digital currencies around the world, countries moving to digital currencies, thinking about making digital currencies a part of you know, their makeup, their country's makeup. And so I don't think it's going away, whether it's a Bitcoin or something down the road, something else down the road, I'm not sure. But for now, the hype around Bitcoin is definitely real. And we're seeing Bitcoin reaching all-time highs. Where it goes from here, some are calling it 100,000 is possible. And some are saying it may, once the hype ends, it may just fall back once again. Maybe not back to 20,000, but it will lose its luster and fall back down again. And comparing that with gold, both of them have been on a similar trajectory. I think Bitcoin has moved a little bit quicker than gold. But again, alternative currencies, alternative choices to the US dollar. And I don't think that's going to end anytime soon. So if you're on the Bitcoin craze, perhaps you ride it a little longer, but be mindful that is definitely not for the faint of heart. And those that are thinking anything has changed regarding Bitcoin, unfortunately for Bitcoin, it really hasn't as yet. Now we come to the part of the show that I always say I like best, where I take a few of your questions, those that are watching today, those that will be hopefully watching the show, maybe on a replay down the road, perhaps later today, because you couldn't tune in at 12 Eastern today. We like to answer as many questions as we can. Today we have a bunch of questions actually that have come in over the past couple of weeks. I want to take one in particular, and that's one on GICs. How do GICs work and how do I use them in my portfolio? So I talk about GICs, and I picked this question in particular because I've been getting a lot of questions on it. A lot of people talking about GICs, money market funds, low risk bonds, investment grade bonds. You know, they ask me, why shouldn't I be buying those today? They're paying in and around 5%, highest rates we've seen in years. Well, I think it comes down to why you want to own that GIC or why you want to own that bond or money market. If you're looking for growth, that's GICs aren't going to give you growth. We've had charts on the show before saying that once you factor in taxes and inflation, you don't really get much growth. However, if you want to put money away into something that is going to be something secure, guaranteed by the government, in this case GICs, then you put your money there. And if you know the market were to fall or to falter, that money you have in that GIC will not go down with the market. So it's kind of like a holding place, a parking lot for money. That's how I use right now money market funds in my portfolios. I choose money market over GICs because GICs tend to be non-cashable. At least those that pay the 5% are non-cashable. Can't get at that money whenever you want them. Whereas money market products, you can sell. Bonds, you can sell on the open market anytime you need access to that cash. So not a big fan of the GIC right now. Be much more inclined if I'm looking for low risk money to or a place to park money. I've been looking lately to money market funds and corporate bonds, A-rated corporate bonds themselves. So I think we're coming to the end of the show. I know we've taken a little extra time, so I think we'll leave it at that for the questions this week. David was a great guest. David Garofalo, great guest today, talking to us about gold. So we went on a little longer. But I want to thank once again everybody for tuning into our show. And I want to welcome everyone to join us again in a couple of weeks on March the 20th, when we talk about money and investing once again, 12 noon Eastern time. And until then, happy investing.